From the morning reading, oil rally accelerates on Friday, stocks bounce on Friday, finish lower for the week. 6 of 9 sectors moved higher and one was unchanged on Friday. XLE, XLB, and XLP were the strongest sectors, while XLV was the weakest sector. Oil futures rose 2.13 to close at 39.66. Brent strengthened as advancers led decliners 3.08 to 1 on the New York Stock Exchange and 1.23 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:09 a.m. Central Time, and I'm recording this in preparation for the market day of April the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, things were generally positive across all 4 of the broad market U.S. indices. The S&P futures were up about 7 points, or about 1/3%. Russell futures were up about 2/3%. NASDAQ was up about 1/3%, as was the Dow futures. Crude oil was down just below scratch. Euro was up just above scratch. Bonds down about 1/4%, and gold up a little over 0.5%. In overseas action, quite mixed. China up about 1.6%, Hong Kong up about 1/3%, Japan down a little over 1/3%, Germany up about 1%, though the United Kingdom is essentially at scratch. In terms of macroeconomic reports for today in the United States, we have, it says Fed announcement. I'm not sure what that exactly is. It says tentative and it says no particular time. So have to do a little bit of research to figure out what that is on the schedule. In terms of Tuesday, we have import prices, and that would seem to be it. So other than this kind of mysterious Fed announcement, which we'll have to get more detail on. Sorry, I don't know what that is. Looks to be pretty light here for the beginning of the week. In terms of current volatility conditions, we have short-term VIX at a 13.59, so relatively low, though it's come up off of some of the lows that it had there for a moment, hanging around the 10 level. Skew very benign. IV percentiles for the S&P and the others also extremely low. S&P a 13, the Russell 22, NASDAQ a 15, and the Dow a 7. You see the action from last week where we were just chattering back and forth, and good bit of price volatility, though not really achieving very much. I mean, the price action at the end of this, bouncing around, is pretty much in the same general area as it was when it started. But you see these multiple standard deviation moves just kind of offsetting each other as they go back and forth. No standard deviation moves were put in on a close-to-close basis on Friday. Let's go ahead and look at the charts. And we'll start off with the S&P futures. And you see what I'm talking about, this recent action. If you go back, let's see, that's Friday, Thursday, Wednesday, Tuesday, and Monday. So from Monday's open, which would have been here, to Friday's close, you would have gone down a bit, so going from 63 to 41, some 20 points. But most of the action of the week was, pretty much within the 2060 to 2035 area. So, and bouncing back and forth between those two sides. So very much a short-term range. And until we kind of play out of this pattern, it's really quite difficult to say where we expect this to go. You can make a lot of arguments. In fact, the morning reading had an author that was suggesting that a lot of bull flag patterns are setting up. And certainly that is a very, very reasonable assumption because that's what it's been doing. And you expect a continuation of what it's been doing to continue until it's proven otherwise. We had bull flag, bull flag, bull flag, bull flag, bull flag, and we expect this to resolve into a breakout out of this bull flag pattern until we break this area here around 2012 on the S&P futures. So that's the expectation. Now, if we should break out of this pattern, and this 2035 area on the S&P futures seems to be very important. We've had many touches of that area on the intraday charts during the course of last week. We break through that area and then break down below the 2025 intraday low from last Thursday, then that would probably bring us into this area here around 2012 or maybe 2000. There's some of the reading from the weekend was calling for a visit, perhaps on a retracement, fib retracement down here to around the 2000 level. And while that might seem like a big move, given the context of where we've come from, that is really a very small fib retracement move. So that's certainly a possibility. We've seen a lot of this kind of weakening of momentum, a little bit of a rolling over, topping kind of action of late, and it would seem that that is a reasonable forecast, while still perhaps holding to that we become a kind of complex bull flag pattern and then eventually make our way up. So this doesn't have to break into a bull flag like today. It may be that we chatter down for several days and then set up for a run to break these highs here. So a couple different ways this could happen, and I think either one of the suggestions that came from the weekend reading or the morning reading authors could be true. It's just a matter of how fast it gets there. In terms of the Russell futures, also the same kind of consolidation pattern, though from a more relatively weak zone. After its historic move up, it's been in a slight bullish channel that continues to move up, and we've not broken that channel as of yet. And yet at the same time, it clearly has lost a lot of the momentum that it had during this 3-4 week period here. On the NASDAQ, again, very much that sideways pattern of late. Again, much like the Russell, relatively weaker compared to the S&P or the Dow. Here are the Dow futures. You can see the Dow's really coming up here in spitting distance of its all-time highs, and frankly, has also run into, as a result, an awful lot of overhead resistance, and that may be starting to weigh on these markets, looking for some sort of energy or impetus, some sort of news event or something like that to drive the energy through these walls of resistance that are sitting in the area just above, frankly, all four of the indices. Let's see if we can get any inclination from bonds and volatility as to where this might be going. Well, bonds seem to have broken up and out, which should be a negative sign for equities. So we'll continue to watch this action carefully, but this is clearly a short-term upward trend. So that would seem to say they expect the equities to go down. Volatility has started to tick up, but hasn't exactly exploded. So that, again, isn't really giving us much in the way of a sign. And then gold. Gold, like bonds at the end of last week, did kind of demonstrate a flight to safety, and that pattern is continuing from last night's action as well. So gold seems to be on the move at this point. Might be something to consider for your watch list if you're not already in. And let's go ahead and go to the daily report. Number of small changes here. We do have in our market timing signals, so we're starting to have additional weakness come in, uptrend under pressure. Our first market timing signal from IBD has fallen to that more cautionary level. Accumulation distribution score on the S&P also fell to a C+. GMI index is at a 4 out of 6. That also fell a notch. It still retains its buy signal that we've had in place since the March the 2nd, but it certainly is weakening. So 2 of the 3 so far. And then if you look down here, we also had an S&P 100 on 4.8 a sell signal, and from the Dow on 4.8 as well a sell signal on their PMO signal. So we have on the short term sell signals coming into place from decision points, one of our mechanical signals, a falling of the score on the GMI, and the IBD signal has also fallen in recent days to uptrend under pressure. So there's quite a bit of evidence here from your market timing signals that there could be something more coming with this weakness. So kind of keep all that in mind. We're still a market in transition until all these time frames align, but that bias now seems to be called into question. We had been a bullish bias, and now this bias seems to be coming around and be more of a short-term bearish bias. Position sizing opinion on the one system is at 50%, the other system 75 to 100%. Intermediate term market posture, though, still quite strong. Still all 4 of them up over 80, though if these fall below 80, that will go to a weak bear intermediate term market posture. So while these are still supportive of a short to intermediate term being in a bullish camp, it's starting to deteriorate, and that may be a sign of continued evidence to this retracement. In terms of the strength of the trend, we're still currently weak, but significantly improved, and you see we're coming up towards the 80 area. The interesting thing here is we're coming back towards an area where it previously reversed, and do we reverse again in this area without actually achieving a strong bull trend and coming up over 80? So this seems to be kind of starting to lose perhaps a little bit of momentum just about the time we're coming into prior highs. The hedge warning status remains level 1. That's caution. Think of tapping the yellow, tapping your brakes as you come into a yellow light, and additional caution warranted. In terms of special opinions, cover call strategy, still maintaining a more aggressive position than most of the recent weeks, though starting to get perhaps a little edgy about this to where we might need to back off a notch. We'll be watching, certainly one of the key things we'll be watching is this intermediate term market posture, and if that falls below at 80, we'll probably start to back down on some of these ratios and so forth with these opinions. Cover call strategies, option income strategies, put selling, all right now are considered to be a-okay to initiate new positions. Just perhaps be pretty selective this week and see where this develops as to where you initiate new positions. If you've already gotten some additional high beta positions, maybe you throw in a couple extra low beta positions. Overall ratio, though, of your portfolio of cover call strategies should be 1 low beta to 2 high beta positions at this point, and then the same thing with 1 in the money strike for every 2 out of the money strikes is the call there. If you want to do some position sizing around put selling, that also could be pretty smart. Keep those as defined risk positions. If you're thinking that the market's about to pull back, it could prove to be an opportunity to set up some new positions, both from a put selling and from cover call strategy standpoint. So this, if it is just a bull flag, it's an opportunity. So hone up your watch list and be looking for those opportunities. We have seen a number of these warnings start to increase, both in number and in their veracity. Our market in decline and sharp increase warnings have both fired. Volatility ratio warning has fired. We have a distribution day count on the NASDAQ is up to a 6 now. VIX phase has been increasing in recent days. Our skew This actually should be less than 125. It is not in warning status. Current 10-day out expected moves of right about a 40, so that just comes into borderline to our warning status. Another area of warning continues to be this key intermarket risk aversion indicators. All 5 of those signals are now flagging as risk off, and that perhaps was the earliest warning sign that we saw coming into the system. In terms of sentiment, nothing really elevated there for stock short or medium term bonds or gold. In terms of individual symbols, we do have 2 right now, LQD and BND, both looking for potential reversal patterns due to extreme sentiment in those areas. On the fear and greed index, this is our compilation that we reference from the 7 fear and greed indicators. That overall score is at a 68, so lower than it was. It was up in this upper quartile there for a couple 3 days. It has been ebbing off a little bit from that at this point. In terms of intermediate term market postures by various markets, it's a very good mix right now of both high beta and more defensive sectors. So this still would say that market should be supportive of additional positions. In terms of the sector specific, though, we've started to see this deterioration start to show up across most sectors. Really only consumer staples and the recent hero, healthcare, are holding up across all 3 time frames, and then energy holding up a little bit in the short to intermediate. But you see all the others have gone to either neutral or even down. And note that the financials is down. Financials, very hard to have a healthy bull market, and so far this year in terms of interest rate sensitivity and so forth is shaping up kind of polar opposite of what many people had forecast for 2016, where they thought that the financials would do well and bonds would get killed. Well, bonds have been doing just fine, thank you, and financials have not been doing very well. So much for the conventional wisdom. In terms of percent change, here you see Friday's action. Energy was the big winner. Materials, industrials, consumer staples, utilities following. Healthcare was the one that gave back some, though you know that healthcare was the one that was probably up the most in much of the recent activity. And indeed, let's take a look at the 5-day and 1 month on healthcare. So the 5-day, second best performance, 1 month, pretty much in the mix. So healthcare has been coming on, but gave up some of that on Friday's action. I think that's probably enough for today. Let's go ahead and go through our wind down sequence. We did send out a couple emails this last week, including an alert that the hedge warning status had increased. And if you'd like to get those alerts, we send out a very limited number of emails, various blog articles and stuff like that, items of general interest to investors and traders. If you'd like to join the email list, just go to this website right here, scroll down just a little bit, see this button, click the button, put your name and email address there. That'll get you all signed up. You also can get a copy of an ebook about portfolio strategy when you do that as well. If you'd like to do this through your smartphone, just go to text Falcon Global, all one word, to the number 22828, and that'll accomplish the same thing. As always, we greatly appreciate you liking us on YouTube. Subscribe to that channel. It's free, and that gives you a heads up to when content has been posted. Also, that allows you to control the playback speed and just use that little access gear. You can make sure that you're watching in high definition and then also play it back at about 1.5 speed. Most of the time people find that they can understand everything and they can still cut some time off of the morning preparations. Now I'll just scroll through the rest of these. If you see something you like, just go to the hyperlink address and we'll go from there. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers, and you notice the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.